Hey everybody, it's Jeff here. Before we get into this week's episode, I wanted to let you know about an exciting offer. You've probably been hearing our ads for FinChat, our favorite platform for researching stocks, and you can use our affiliate link to get a nice 15% discount. But for the next couple days, that discount is going up to 25%. So starting on Monday, April 28th and running through Thursday, May 1st, if you use our link, which is finchat.io/unscripted, you can get 25% off a membership rather than the normal 15%. So if you're hearing this on this week's episode and you have time before May 1st and you want to get a nice discount, go ahead and use our link. That's finchat.io/unscripted and grab a 25% discount right now.
Hey everybody, it is mailbag time here at Investing Unscripted. We're going to answer your hard questions about investing in personal finance. Not going to be your answers, they're going to be our answers, but we're still going to answer them, that's for sure. I'm Jason Hall, joined by the voice of the people, Jeff Santoro. Hey Jeff.
Hello, how are you?
I'm good. You see I'm mixing up the intro here, doing things a little different.
It's weird, man. I don't know if I like it.
It's okay. It takes time. Change management's challenging. It's okay. I understand that. We're also recording this episode much later in the day than we typically do. This might be our first official episode of Investing Unscripted After Dark.
Yeah, the vibes are different and weird. You're changing up the intro. You're more distracted than usual, which is saying a lot.
No, it's not possible. Now, it's mailbag time though, and we're keeping it a little bit lighter this month. We've curated 3 questions that we want to answer, and partly because 2 of the 3 are a little more in depth. They're a little bit different parts of them that we need to take apart a little bit. So that's going to take a little bit more time than we might normally take when answering questions. Plus, you're just getting back from some time away. I'm going to be taking some time away here in the next couple of days. So this is probably going to be a little bit shorter episode than we typically do too.
Yeah. And it's also weird because we haven't actually recorded together in a couple of weeks because we did a bunch early and we ran a guest pod of the Chit Chat Stocks podcast last week. So yeah, we have these times in the year when one or both of us are traveling and we seem to have a little bit more of an intermittent recording schedule, but hopefully for the listener, it's steady every Wednesday. We're keeping them coming, and we'll be traveling together next week, Jason. We're heading out to Omaha to visit the Oracle. So when this episode drops, we will be just hours away from flying to Omaha, Nebraska to hang out with Warren.
We're going to be flying there together, which is always fun for us and distracting for the flight crew. But
I think we're going to meet like we did last time. We're going to meet on the connecting flight.
Yep. That's right. We'll be nice and boisterous by the time we do get to Omaha, but looking forward to that. Anybody that you hear this and you weren't aware that we were traveling, please let us know. You can DM us on any of our social. You can email investingunscripted@gmail.com. Reach out to us. Let us know if you're going to be in Omaha, and I'm going to try and do a meetup. Heard from a few folks already, but it'd be great to get together with some folks if we can. So let's do that. All right. You ready to jump in and answer the first question here?
Let's do it. All right. As you said, these are multi-part questions that are going to require some longer answers, so they're a little bit longer to read as well. So here we go. This email comes from loyal listener Dirk Diggler.
Yeah.
Which is perfect. What?
Long time listener.
I have a very long investment time horizon. I have held on to my stocks and have not sold except for maybe 5% of the companies I've ever invested in. I've got a grip on my investment. It's about 12 years ago or so, after being educated on what a 401k really is and the free money company match, which comes with each paycheck contribution. I've nailed my investment choice in a mutual fund which tracked the NASDAQ. I left that job and transferred the account to a rollover IRA. I discovered me not buying and selling out of the investments all the time and just holding in one fund for the entire 8-year employment time span, how incredibly the account grew. My question is, what are each of your investment time spans or horizons for 1, a speculative starter position before you pull the plug, 2, a strong conviction starter position before you pull the plug, 3, a long held position, how much longer do you give it before you pull the plug? Also, what are your definitions for what a long-term investment is? Mine is at a rock bottom 5 years. Enjoying the meteoric rise of the podcast, loyal listener, Dirk Diggler. So a lot here to unpack, Jason. So basically he's bucketing his question into speculative starter positions, strong conviction starter positions, and a long held position. How long do you wait before you pull the plug on something?
All I know is that Dirk's got a lot of questions about things that are long, how long things are.
He does.
Yeah.
Yeah.
All right. So very first thing, I would be remiss to not talk about that first part there where Dirk says, I nailed my investment choice in a mutual fund which tracked the NASDAQ. So I'm going back to the beginning of 2013, roughly 12 years ago. And I'm just going to throw a number out there. Let's say that Dirk started with $10,000, made a $10,000 contribution. Now, it's not going to scale exactly because it's a 401k, right? Making the regular contributions every pay period. But just the starting point in the NASDAQ composite back then, just that $10,000 has generated about 15.8% in returns a year versus 13.3% for the S&P. Now, that 13.3% for the S&P is exceptionally good. That's like a third better than the market's long-term average. It's been that good. So Dirk has managed to get close to 60% better than average returns. Just holding that $10,000 initial investment would be worth almost $61,000 today. That's with the market down. For context, the S&P, an investment in the S&P, the broader index, would be worth about 46 grand. So we're talking an extra $13,000 by having the combination of foresight and luck, let's be honest, to have invested into a tech-heavy index at that time. Right. And there's been periods of underperformance. Remember 2020, it was brutal for tech stocks. Right. So kudos to you right there. All right. Let's start answering these specific questions about the idea of how long are you talking about holding? What are you thinking about it as timelines? So how do you want to do this, Jeff?
I like the last thing he asked. Let's define what we consider to be a long-term investment. He said his is 5 years. I think that's a pretty good benchmark in terms of what is a long-term investment. Like, I think if you sell something after 5 years, I don't think you can be accused of pulling the plug early. You know what I mean?
Yeah.
You could make the argument if you sell something after 1 year, maybe 2, that's a little hasty if you really want to call yourself a long-term investor. I think 5 is pretty fair. Now, that said, you could still miss and make a mistake, right? The example that always sticks out in my mind when I hear 5 years is before, I think 2019, 2020-ish, before Tesla really kind of took off as a stock, it traded sideways for about 5 years. So depending on like what 5 year, I'm just using that as an example because it always sticks out in my mind, but depending on what 5 year span you pick, you could end up being early to get out of something and miss a big rise after that. But I think 5 years is fair. What about you?
Yeah. And it's funny because it goes back to, we had a conversation with Brian Withers a few years ago, and Brian talked about really, really learning what long-term really means. And if you're not thinking 5 years, 10 years plus, then you're not really thinking long-term. I think as a starting point, thinking about like a 5+ year period makes sense. If you're talking about a fundamentals, bottom up, finding great businesses, owning those businesses, either great businesses or businesses you think can be great, and giving the business time for things to play out.
Yeah.
Yeah, I think that makes sense.
But he's asking if we distinguish between our starter positions or something that has gone beyond that.
Right.
Does our investment time frame change?
The key is the first two, like a speculative starter position, a more strong conviction starter position. So I do think about from a time perspective, I'm still thinking unless something just goes clearly sideways. Right.
Yeah, I think you throw all this out the window if you're like your thesis is completely busted or there's some massive change with the company. And I don't mean price movement.
Right. Yeah.
I mean like a massive change with the actual investment thesis.
And even sometimes with things going massively sideways, I still tend to, especially with the more speculative things, right? And I want, in that bucket of speculative stocks, I want to be specific about what that means to me. And I'd like to hear from you, Jeff. It's two things. Either the business is trying to do something disruptive or new, or there's something there and I've got to learn more about it, right? And it's, sure, maybe there's risk there, but maybe it's more or less speculative, but it's my knowledge that needs to grow to really be able to more clearly define that. But if I'm putting it in that bucket, position sizing matters as much as the size of the starting position. And I'm still thinking generally 5+ years. It's a little bit of the Buffett, our ideal holding position is forever. There's the ideal, and then there's what you end up doing. So with the stronger conviction starter positions, I don't know that I love that phraseology. I think I get what Dirk is getting at here, and that I don't really bucket my portfolio the same way, because sometimes I do have strong conviction in businesses that are still disruptors or that might be viewed as speculative or higher risk. Like in phase right now is viewed as extremely high risk by a lot of investors, I have very high conviction in it. So what I think about is more of like proven businesses,
Yeah.
right?
Yeah, I'm thinking of the same thing. Like I'll give you a couple examples from my portfolio. Rocket Lab, not a company I own yet, but I've traded options using that ticker. I've sold calls against some shares before. Were I to buy a regular position in that company for my portfolio, I would view that as a speculative starter position.
So to be clear about what you've done so far, you bought shares in 100 share lots specifically to sell covered calls against.
Correct. So I have enough knowledge about and interest in the company where if I get stuck with those 100 shares because my option strategy doesn't go the way I want with it, I'm okay with it. But also if I lose those shares, it's fine because I've dedicated it to this strategy. But I've thought about actually putting Rocket Lab into my portfolio as like a legit starter position, but I haven't yet. But that would be one where I would, using his terminology here, maybe think of that as like a speculative starter position. Now contrast that with Costco, which is my most recent new addition to my portfolio, which was still a starter position. It's not speculative. Like I'm not worried about Costco's future. That was, I bought that when I bought it to get it in my portfolio so that I could just track it better and learn more about it and then buy more at opportune times from a valuation standpoint.
So
right?
Jeff, so this one to me, I'm glad you said that because this one to me, use your terminology here, but my observation of you is like most people that understand it, you have extremely high conviction in Costco, the business.
Correct.
But not necessarily in Costco, the stock at these prices.
Right. So like using those two as an example, like I would never make Rocket Lab a big enough position right now where if it went to zero or dropped 90%, I would like freak out because I'm going to go broke or something like that. It would be so small in my portfolio that it really does no damage if it goes to zero. But I'll learn about it, maybe add to it over time. And I could see that being a 5+ year quote unquote starter position as I watch the business grow and just establish itself and or flame out, to make a rocket joke. But like that's so I think I'd actually have a pretty long horizon because of how small of a position it is, right? And I think you were getting at that same thing.
Yeah.
But I'll tell you what, if I got 2 or 3 years into that and just found myself continually unable to add to it, that's where I might pull the cord on like year 4 or 5. And I've done that before where like I spend so much time thinking about a stock and I can't bring myself to add to it because I'm so concerned about something and I just end up bailing on it. I don't think that happens with Costco. Like I can't imagine a scenario in which I bail on that business.
I want to talk about what 5 years looks like, Jeff, because 5 years might seem like it's maybe too long, but things can change in the real world in ways that affect businesses and force them to pivot or accelerate their growth or restrict their growth in big ways. And to me, thinking about 5 or more years, it gives managements time to prove out the business model, the product, all of the stuff, all the blocking and tackling of running a business, allocating capital, establishing a market, building market share, figuring out if there are moats that they have, like all of the stuff that you want a business to be able to do. Think about the past 5 years. We've had a global pandemic. We've had the largest global government financial stimulus ever provided in the history of the world. We've had the lowest interest rates since we went through a near global economic collapse, the highest interest rates in the past 4 decades, the highest inflation in the past 4 decades, 2 bear markets, and 2 of the best back-to-back years in the stock market's history.
Mm-hmm.
All of those things have happened in the past 5 years.
Yeah, it depends which 5 years you're looking at.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, Go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brent.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
I mean, that's the thing, right? And right now, you could say the best economy in multiple decades is at risk of being crushed, right, by a global trade war. Point is that a lot of things can happen outside the business. And one of the things that I like to see is that great products, great businesses that have something unique and special and you can actually make money with, they figure out how to adapt and do it across those sorts of environments. So the ones that don't, generally you find out after 5 years. And if you just have a small bit of exposure, doesn't matter, right?
Yeah. And that's the thing. The three things he asked us about: a speculative starter position, a strong conviction starter position, and a long held position. And then in parentheses, each time said, and when do you pull the plug? And I don't know. I don't really ever think about any of those things through the lens of like when I'm going to pull the plug on it. I'm more likely to, what happens to me more often is I just realize I was wrong about why I bought it. I think this is happening less to me now because my more recent purchases, I'd like to think I was smarter about. Like I still have some stocks in my portfolio that I bought 5 years ago when I was brand new. And the ones I've sold out of that kind of cohort over the past, let's say year and a half are ones where I never really had a reason for owning it to begin with. Like I still feel like I have a couple in there that maybe I can chalk up to being young and naive, but I have enough conviction in them, or at least interest in seeing how they turn out, where I haven't sold them yet. But that's typically what happens to me is I'll own something for a few years and then say to myself, I actually don't think this company has any kind of competitive advantage. Like and that's something that I probably would have realized if I was going to buy it now, but I didn't think of that 5 years ago.
Yeah.
Right. And if I feel like even now I can't see where their competitive advantage is, then I might pull the cord. But I think what I'd like to say about all of these questions is I really do try not to do it because of price movement.
Yeah.
And I probably do more than I want to give myself credit for because I think it's hard to not have that play into it. Because look, I'll be honest, I have stocks that I haven't sold yet that I bought on a lark, not knowing what I was doing, that are in my portfolio because they're up like 300%.
Right.
Like I'm being 100%, like the two that come to mind are Broadcom and Arista Networks. I bought those way early. They've been they've risen crazily because of AI stuff. And if the AI tailwinds had not come around, and if they were sitting at the bottom of my portfolio down 80%, I probably would have sold them because I don't understand them as well as I wish I did, because they're very, in my mind, in my brain, hard to wrap my head around, but they've really done well. So I'd be lying if I said like, oh no, I'm an expert on those, that's why I hold them. So I think to some degree, price does play into it.
It does, but here's the thing too about holding stocks that have gone up. Any stock can go up quickly in a short period of time for no real material reason based on the quality of the business, right? But when you do start getting into these 2, 3, 4, 5+ year runs and stocks have moved up, at some point the market's going to be weighing the value of the business itself and its earnings and free cash flow generation, those sorts of things. So the two hardest things to do are to find winning stocks and hold winning stocks, right? So if you were lucky to find a winning stock, continuing to hold it is the logical thing to do.
Yeah. And I'll say this too about those two, just to give myself a little bit of credit. I think the stock has run up more than it should have. There's definitely been multiple expansion in there.
Especially, yeah.
But the tailwinds that are behind the two companies are legitimate.
Yep.
If the AI spend continues, and this is we're not in the pre-popping bubble part of the cycle, they're going to continue to do okay and be long-term winners. And they've been long-term winners prior to this too. They've been good companies. It's not like it's a micro cap that went up 400% in 3 months. That's a different story. All right. I think we've covered that one pretty well. Let's move on to our next question here from Dan via email. Dan says, here's a super specific optimizing question. I currently have my emergency fund parked in a high yield savings account earning 4.1%. This always seemed like the smartest and safest move given the high rates and the fact that money is easily accessible. Though recently it was suggested by another finance podcast that it makes more sense to put that money into a Roth IRA and put it into a money market fund. The positives of this are that there's no taxes on the interest growth in the Roth, and it would decrease my taxable income because I would be contributing the $7,000 through my 403b pre-tax. The negatives is that it would take years to get all of that money into the account because you can only contribute $7,000 a year into the Roth. And that's also $7,000 a year that wouldn't be invested in stocks in the Roth that could grow tax-free, although he would offset that by upping the contributions to his retirement account. So let me know what you think. Thanks, Dan. Yeah, so this is interesting. The first thing that popped out to me in this question is, if you had told me 5 years ago interest rates are going to be 4% in a few years, I would have been like, oh God, I can't wait to put all my cash into a high yield savings account. And then it's like you get there and you're like, but is there a better place I could put my cash? Like we're all always trying to chase yield. The second thing I would say is no one should be listening to any other finance podcasts. I mean, let's be honest.
Especially whoever suggested this.
All right, so here, let's talk through it. So I get the desire to, looking at the two positives, I get the desire to avoid paying taxes on the interest growth, right? Because it's in the Roth and it's tax deferred. That's great. I understand that.
This is like riding a skateboard to work because you don't have to buy fuel for your car, but your office is 25 miles away.
All right, I'm not that negative on it. I'm willing to consider here, but go continue. Go ahead.
Okay. All right. I am having to control myself right now because I am so full of righteous fury about this, Jeff. The more that I think about it, the more angry I become.
Okay, say more.
Okay. All right. So here's the things that I get. I get the idea of yield arbitrage. You can throw the money in a money market and you can get a little bit better yield. Okay, that's cool. Open a damn taxable brokerage account at Fidelity and you can buy a money market and you can get that higher yield. You don't have to do it in a Roth. Okay. So let's go ahead and debunk that number one. 1A, I love the idea of this supposed tax efficiency, right? Because you put it in the Roth and the interest that you earn is shielded. Great. You're going to save about $100 a year in taxes on $7,000. Fantastic. You know what you just did, pal? You're earning 4% a year in a Roth. You remember that previous question that we answered? We talked about those 12%, 15% a year returns. Okay, those are unrealistic to expect that to continue in perpetuity. But let's just say you only underperformed the market, the S&P 500 long-term average, and you got 8% a year. You're doubling what you're getting. The value of a Roth is not a tax avoidance strategy for your emergency fund. It's a way to arrive at retirement with tens or hundreds of thousands of dollars of wealth that you can use for income tax optionality. Once you're retired, let's say you have a pension or Social Security or both. You've got that fixed income that's coming in. Then you have your retirement accounts, your accounts that you've contributed to, that's your money that you can take it out whenever you want. You're going to have required minimum distributions, right? For your 403b, 401k, those sorts of things. Once you get to a certain age, you have to take minimum distributions, okay? Also, you only have a certain amount of money that you can take out, right? So you've got that money. You know what your cost of living is going to be. You know how much you want to take. Certain years you're going to splurge and do extra stuff. This is the thing about being retired that nobody ever thinks about. The years that you want to do extra stuff, you're not going to be tapping savings to do that. You're going to be tapping your retirement accounts. You know what you do when you tap your retirement accounts? You increase your taxable income. You go buy a boat one year, you spend 75 grand on a boat, 50 grand, whatever it is, you just increase your taxable income by the amount that you took out of your 401k.
Plus, nobody should ever buy a boat.
Oh, 100%.
Yeah.
Especially Ben Carlson, but that's Ben's problem. Ben, your family loves you more than my family loves me. So good for you. So you see my point, right? Mm-hmm. When you have a Roth, not as some being clever, but not being smart, turning it into some sort of emergency fund vehicle, when you actually have a Roth that you use it as a long-term wealth creating device, when you hit those things in retirements that are going to raise your income certain years, you can pull the money out of the Roth and not snatch yourself up into a higher tax bracket because you wanted to buy something expensive one year. You wanted to take the family on a big cruise, whatever it is, whatever you want to do with your life. right? The Roth is the most untapped tool for people that are in income brackets that have enough disposable income to maximize, that to do something like this, you're stepping over dollars to pick up pennies.
So that all makes sense. But I have a simpler, I think, reason for not liking this strategy. And it's the second negative that Dan listed here. So he wrote negative number 2 is that this would be 7,000. Well, I'll read both of them just to recap. So like the first was that it would take a long time to get all the money into the account because if you can only contribute $7,000 a year into your Roth, right? So let's just, I don't know how much Dan's talking about here, but let's just say he has a $50,000 emergency fund.
Yep.
At $7,000 a year, it's going to take
7 years.
And who knows what interest rates will be like over the course of 7 years, right? You could start this strategy, get 3 years into it, and then now interest rates are back down to 2%, and now it's a whole different calculus. But the second point, he says,
won't be Dan, but we'll play along.
He says that $7,000 a year I wouldn't be investing in my Roth, and I think
that's exactly it.
That's the biggest thing to me. He says he would offset that by taking, that equivalent amount of money and putting into his retirement account, his 403b. But
here's my guess, Dan. Jeff, here's my guess. 403bs are specifically for educators, or it's for government employees?
Public employees. But it's mostly teachers have.
They're generally crap, right?
Yeah, that's where I'm coming at it from my knowledge of my own 403b. I'm lucky. I found a way to have one that has relatively low fees, and I'm just in Vanguard index funds. Most of them are not that. Most of them have higher fees, and you're paying a person to manage an account that you actually don't need managed because you don't ever make any changes, right?
So whatever you're picking up in higher interest yield on that savings, you're giving back to somebody else in higher fees.
But even if, let's just say you're in the ideal scenario, right? And your 403b is all low fee Vanguard index funds like
you
mine.
Almost said Van Dam.
I did say Van Dam index funds sound awesome.
They're very flexible.
But let's just say you have like the best case scenario. I'd still rather have that flexibility in my Roth because you can do so many different things. Like you can't buy individual stocks in your 403b. You can't buy crypto if that's your thing in your 403b, right? Like you just have more flexibility in the Roth.
Yeah.
And if you're going to invest $7,000 somewhere, I'd rather invest that in the Roth and not use the Roth as the vehicle to squeeze out a little extra savings account yield.
Yeah, I see a lot of people doing this. And you know what? The first thing, Dan, I love thinking through this. These thought exercises are so valuable because every once in a while you actually come across something that is useful and that does make sense to do. But the biggest risk to me of something like this is that you're defanging one of your best offensive weapons for creating wealth for the long term, which is the Roth IRA. So yeah, that's why I absolutely hate it. I don't think it's worth it.
Yeah. And the other thing, just to come back to basics, is like, I try to think of my emergency fund as a thing that it's nice that I can get 4% on it now in a high yield savings account, which that's what I do with mine. But if that went to 0 tomorrow, I still would just leave it there because it is there just to be a safety blanket.
It doesn't exist to increase in value. It exists to protect.
It's there. It's insurance.
Yeah.
Right.
Yeah.
It's like you don't get a yield.
It's insurance that you get to keep the premium.
Right. But you're not, I'm just going to say, you don't get a yield on your insurance premium. Like you're not getting 2% back on your car insurance every year.
But the insurer does. And in this case, you're self-insuring. So it makes sense to maximize the return while protecting the value of that asset. So yeah.
Yeah. Now within savings vehicles, like I have no problem thinking creatively about yield, right? Take some of that emergency fund, spread it out over a CD ladder, right? So if your high yield savings account is 4.1% and you can get a 2-year CD at 4.9%, maybe do that. Like I've done that with some of my cash. Like I don't have a problem with that.
Just make sure you're not blowing up the purpose of having that cash. If you lock up,
no, you have to do it
far out. Yeah, no, that's
like I did it with college. I did it with money I wanted to keep to pay for my kids' college, and that's a defined period of time.
Exactly.
Right. Like I have the 529 to get us started first year, second year, third year, depending on how cheap or expensive college is for him. Mm-hmm. And then I have cash just kick in as step 2. So I might need that 2 years from now. I might need that 3 years from now, or I might need that 4 years from now, but I know I won't need it a year from now. So I'm fine putting that in a 1-year CD. Right. You know what I mean? So yeah, you have to be smart about where you put it. But like that sort of yield hunting, I don't have any problem with.
Oh, absolutely.
Because it's separate, right?
There's no reason why
fund and then like a big brick wall and then investing money is how I think about it.
I think another thing to remember too is that we haven't seen it be an issue, but money markets are treasuries, right? They're not FDIC insured deposits. It's important too to remember that if you own a money market, if you're invested in a money market account, you don't own the treasuries either, right? You don't have the full faith and credit of the federal government backing it up. You're an investor in that fund, and we're trusting that the fund actually has the assets that are backing up the dollar value of the fund itself, right? Again, if you invest with Fidelity or Vanguard or iShares or any of these large institutional investors, you're in pretty good hands generally. But we've seen a lot of companies we thought were pretty stable, great businesses that turned out that weren't. So again, just be aware too that you start moving into these asset classes and all of a sudden there's a reason you get a little bit more yield. It's not exactly the same thing. So
Yeah.
just stuff to remember. That's all. Stuff to remember.
All right. Last question.
You could probably buy a coffee cup cheaper than a hammer, but I'm pretty sure the hammer is still the better hammer.
Okay.
Use the appropriate tools is what I'm saying, Jeff. Use the appropriate tools.
Okay. I'm going to move on from that. So Cunning Project asks, why do we consider companies like
You're such a
Coca-Cola,
crap beer guy.
AB InBev, Hershey, Estee Lauder, defensive consumer non-cyclical? If the economy hits the fan, I'm certainly not reaching for a Coke, a beer, a candy bar, and makeup to soothe the pain. Make it make sense. So speak for yourself, Cunning Project. But when I'm feeling stressed out about the economy, I absolutely crack open a Coke and a beer and a candy bar, and I put makeup on. So
Yeah, I helped.
Speak for yourself.
Put the makeup on too. Yeah, he just says, "Make me look pretty." I spent $6.50 for what last year was $4 worth of candy
yes.
for my kid's Easter that I may or may not have eaten a substantial amount before he woke up. Number one, here's one of the biggest investing lessons that I've learned over time is that we are each a data point of one, and it's often useless and counterproductive to identifying good investments. Our own built-in biases get in the way all the time, right? So here's the theory, and there's some data to back it up. When you think about things like Coca-Cola's brands, Warren Buffett has talked about one of his favorite moats as being that, a durable brand because of customer loyalty. Again, Bud, AB InBev, roughly 1 out of 4, 1 out of 5 beers consumed on the planet come out of other breweries. So massive collection of brands. Hershey, there's not much to say. Hershey owns a bunch of other brands too, besides just the legacy Hershey brands. And of course, Estee Lauder. What's interesting about most of those particular stocks is there's been a lot of business struggle across them over the past 4 or 5 years. Estee Lauder, for example, their business in China, they really banked heavily on China and that backfired. That didn't go well. Hershey, between inflation, cocoa prices spiking, increased competition in the candy aisle, and some investments they made in some other like salty snacks and that kind of thing that haven't gone great. Hershey stock hasn't done well at all. AB InBev, that whole category has been challenged for a while now. Kind of peak beer, I guess, in a way. The impact of seltzers and vodka soda seltzers on that category have been tough. Even the craft brewers, Jeff, have had a tough time over the past few years. Coca-Cola's volumes have been in decline for the better part of a decade. Their margin and their revenue growth has been just raising prices, right? So there's a little bit of a kind of a crack in the foundation for a lot of like that train of thought that these consumer brands prove to be durable across economic environments. But there's still some truth to it, right? There is still some truth to it. But I will say that broadly, I don't know that this is necessarily an investable idea anymore in the same way that it used to be. Because Jeff, I do believe that the combination of social media, e-commerce, and the global manufacturing supply chain has broken down the moats for these businesses that was just as valuable to their brands. And that was the ability to own the point of purchase, having that shelf space, right?
Mm-hmm.
In the grocery store. If you're Budweiser, you actually pay to have the shelf space that's eye level in the stores, right? Hershey, you pay money to be on the end caps next to the registers, right? So little things like that in the age of e-commerce and social media, has leveled the playing field in some pretty substantial ways where brand equity and creating that loyalty is not as valuable as it used to be.
Yeah, I largely agree with that. I think a few things. One, just to talk about one aspect of this that I don't think you hit on yet. When times get tough and like the economy hits the skids and people start feeling like they have to pull back and spend less money, one thing that all of these have in common is they are they cost less money than some larger ticket items. So for example,
Right. They cost more than the private labels, but a Coke's couple bucks.
Right. And I think if you are loyal to these brands and you are cutting back in other aspects of your life because of economic uncertainty, right? You're eating out at restaurants less often. You're going to less baseball games, even though you're a huge baseball fan, right? You're delaying a new car purchase. You're whatever, like you're making these larger, big dollar amount decisions to just be a little bit more discerning on your spending. But then you might see that Snickers bar, or I don't know, Hershey bar, I guess, to use the companies mentioned here, or you might see that bottle of Coke, or you might go past the makeup aisle and look at your favorite lipstick, whatever it is, and say to yourself, that's $3. I'm going to splurge. I'm going to make myself feel happy right now and spend this $3. Whereas you're not going to go, oh, that concert ticket's $300. I'm going to splurge and buy that 300. People actually call it the lipstick effect.
That's exactly right. Yeah.
Right. So
yeah,
there's that aspect of this too. But I wasn't even thinking about the breakdown in brand loyalty just across a lot of these historically leading brands. Like, I think there's brand loyalty with Coke. I think there are some people who won't drink a Pepsi, won't drink the whatever, ShopRite Cola, right? Like they will only drink Coca-Cola. I know that there are people that are very loyal to specific beers, but there was also way less choice 50 years ago.
Right.
Right.
Yep.
In all of these categories, the reason that they were able to establish those brands was partially because there just wasn't as much other choice. I really do wonder if you're a kid growing up now, like I didn't let my kids have Coke until they were like 10. They just didn't have soda. And now I don't think they have a loyalty to any specific soda. And so I just wonder if this is going to continue to break down over time. Like beer, perfect example. Like when we were in college, Jason, like craft beer wasn't really a thing yet. Like the closest you could get was like Sam Adams. That was craft beer.
Yeah.
And now you look at Sam Adams and I'm like, it might as well be Budweiser. It's just as corporate America as the big brands.
We had Terrapin in Athens, Georgia. Terrapin makes some pretty good beer, but mostly it was PBR.
No, I'm not saying they didn't. There were craft breweries around here too, but like it was very few and far between. Like you were.
Well, and the funny thing too with craft, and this is one of the interesting things that's changed, is one thing about the typical craft beer buyer is there is no typical craft beer buyer, and they're very likely to buy something different the next time they go to the store. So that's one of the things that certainly has changed. And it's interesting because one of the things that's happened since the idea of the lipstick effect is the share of wallets of things like food as a percentage of people's income has fallen enormously, right? As the costs for food production and the costs for so many of these the cosmetics and things have come down, that all of those things combined have changed the economic value of those things for companies, where sure, it may not be particularly expensive, but again, there's just less loyalty that creates that value for the brands where they're moats. You look at them for the most part, Coca-Cola, for example, since Buffett bought his last share of Coca-Cola back in 94, Coke stock has massively underperformed the S&P 500. You wouldn't know that by what the glowing things that Buffett has said about the company, but Coke's up 1,300%. That includes dividends, while the S&P's up almost 2,000%. So, I mean, we're talking not just underperforming the market, but underperforming a very strong bull market and underperforming the market's long-term average, less than 9% annualized return. So I do think that I think that there's value for those businesses in those periods, but when the economy's strong, when there's growth, which is most of the time, Jeff, then that defensive positioning, it doesn't really translate to value for investors who are looking to outperform the market.
Yeah. The last two things I want to say on this. One is it'll be interesting to watch these types of companies, how they do the next time we have a legit prolonged recession, right? Like the last time we've had a really rough recession was the great financial crisis. And these brands are in different places, I think, now than they were back then. Yeah. Unless we have a really deep recession, like very soon, we're going to be going on almost 20 years since the last one. So the brands have deteriorated, I think, since then. So it'll be interesting to see whenever that happens, how they hold up. And then the last thing is the whole idea of calling these stocks defensive consumer, non-cyclical, like these categories that we give to stocks when we talk about like the market writ large, are kind of silly old school groupings anyway. Right. I wouldn't make any decisions on a company just because it fits into some category when you look it up on Morningstar or something like that. Because there are some oddball legacy tags that whoever decides these things gives to these companies that I don't know how applicable they are anymore.
Yeah, I think that's right. And I think we should distinguish these businesses from like true consumer staples companies, that some of the better consumer staples companies, that again, these are still discretionary items.
Right.
That Cunning Project's example gave here. These aren't things that you're going to use, dish soap and that sort of thing, toothpaste, cleaning products, that those companies that do have more of a defensible mode broadly, that seems like it's held up better. But again, same thing, you don't necessarily see buckets and buckets of outperformance for those businesses as well. So to me, I think the more important thing, the way I think about it, is thinking back to goals and what we're trying to accomplish. So with Dan's examples, like your emergency fund, what's the purpose it serves? Make sure I have money if I need money in the near term. And I don't have to turn stocks into money at a time that stocks are worth a lot less money than they would have been 6 months before, right? So when I think about these sorts of businesses, I throw a lot of that stuff out the window, and I'm really corely focused on what can this do for me, this investment? What do I think it can do to help me reach my financial goals over that 5+ year kind of horizon, with very few exceptions that I might do something on a shorter term period. But by and large, I think it's an interesting little kind of intellectual curiosity to scratch. But I think one of the mistakes that a lot of investors make in periods like this is looking for stocks that are safer to lose less money, right? To try to prop up their portfolios for a period of time, versus accepting the reality that when you buy stocks, part of the risk is the stocks are going to be volatile during downtimes as well, when periods like this. And on the other side of it, that's why we want to own them.
The problem is the time you want to own the defensive stocks is the time you think about it is when
Everybody
the
else
market's
is
going
already
down, and that's when they're expensive.
Yeah, that's exactly right.
It's funny because I've talked about this a lot. I sort my portfolio spreadsheet by basically a calculation that's like size of position and also how well it's done versus the S&P 500. And one of the companies that is like over the past year worked its way into like the top 5, where it used to be like middle of the portfolio, maybe like bottom third, is Berkshire Hathaway, because it has outperformed the market and it's a relatively small position for me. But the time to add to it would have been when it was down lower on my portfolio, when everyone was dunking on Buffett and saying he was done. That would have been the time to load up on shares. Now, that's when I bought some. So I caught that a little bit. But now that it's sort of floating its way to the top of my portfolio, the way that I sort things.
You mean when Buffett topped the market and now has $300 billion in cash just sitting there?
Yeah.
That guy's lost. I didn't know what the hell he's doing.
Yeah. It's almost like he's good at this. All right. So before we wrap things up here, since we're a little short, I just want to take a minute to encourage our wonderful listeners to do a couple things to help us out. Number one, if you enjoy the show, if you are a regular listener, if this is one of the podcasts that you most look forward to checking out, share it with a friend, send it to someone, click that little share button in your podcast app, send it to a friend who likes investing or just likes to hear two middle-aged dudes talk. And then also, if you haven't yet, give us a 5-star rating and a review on the podcast apps. That's super helpful. It's one of the biggest ways we can get new listeners to the show, other than you just sharing it directly, is if they see it pop up in their feeds. And that happens more often the higher our ratings are and our reviews, and the more positive our reviews are. And then lastly, if you'd like to have us answer one of your questions in a future mailbag, we do one every month, typically near the middle or the end, but you can send us questions at any time. Email's the easiest, but however you get them to us, we will find them and we will put them on our planner and we will answer them sometime in the future.
Probably.
Most likely. Maybe. Well, if you insult one of us or both of us.
Oh, yeah, absolutely.
Then we will absolutely answer your question.
Yeah, we're probably going to lead the show with it. That's exactly right. Okay. Well, just a reminder too, let me say it again. If you're going to be in Omaha, let us know, reach out to us. That'd be cool to see you. If not, reach out to us anyway. Like Jeff said.
Reach out and tell us you're not going to be there.
Yeah. Oh, please. Especially that.
Yeah.
God, we're so dumb. Okay, Jeff, I think that's it, right? That's it for this mailbag?
Yeah, that's it. We're saying stupid things, so it's time to end the show.
Wait, so what's different?
Fair.
Okay, since we're at the end, this is the part where I remind everybody that we love to give our answers to these hard, complex questions about investing and personal finance. Sometimes they get weird and mixed up. We're here to help sort out the mixed up and keep you from doing dumb stuff, like keeping your emergency savings in a Roth IRA. But those are just our opinions, man. Just our answers to these questions. Still up to you to make sure that you figure out what's the right answer for you. But you know what? You can do it. Even you, Dan. I believe in you. All right, Jeff. We'll see you next time.
See you next time.